part 2 of webinar 3. This is range trading, the Arizona rules, the Tucson phase. One major problem with range trading is that it's very difficult to identify a range. I've learned probably 50 different range trading programs over the course of my 12-year trading career, and one primary problem with every single one of them is the initial identification of a range. I read articles about it and it says, oh, when there's a range, do this. Well, the problem is, when the heck is a range? And when the heck is identifiable range? When does it occur? And I can handle the trading strategies from there, but when does the identification of a range occur? Well, Bishop Campbell and I have wrestled with the angel of range trading for days now, and we've come out of the desert, and we do have some definitions. Some are older definitions and some are newer definitions, and we have two primary methods of trading that we've identified as useful to identify the range and then also trade it. Bishop Campbell, tell us about your experience in the problems associated with range trading, how you solved those problems, and any other items that you'd like to bring up.
Okay. Well, first off, there were problems with running the trend trading on this system. First off, and I kind of didn't know how to deal with it. There are a lot of times where price moves sideways and didn't want to trend trade it, but I didn't know what else to do. I almost just turned the system off when I got there. Didn't even want to. I wanted to just turn everything off and start trading again when price started to move. But then I couldn't even determine when price was going to move again, so I had to trade everything. So I wanted a system that was going to kind of weed out the sideways movement and then make a system that allowed me to trade it.
Yeah. One thing that I thought was really interesting that you said was that the plain old identification of a range was very difficult. Did you finally give up on just trying to identify it completely?
No, actually, so what I did was I took the 800. I figured that if the 800 period simple moving average is the mean for the whole thing, then once price approaches the mean, that's where price is probably going to range trade. That's where things are probably going to slow down and people are going to build positions and consolidation, all of that. So I decided, okay, if price is going to hang around the 800, then I have to identify a way to trade as price moves around the 800 period simple moving average. If it pulls away, it's obviously in a trend, but I want to trade. If you look at the chart that you've got up right there, there are times where the 170 just dips below and then above and then below, and those are problematic for trend trading, right? I mean, you get killed every time you try and trend trade in there.
Right. Well, what I've noticed and what you've noticed is that the 800 period simple moving average is a somewhat arbitrary definition of a range. When the currency pair strikes the 800 period simple moving average after having trended, that is the immediate definition of and the turning on of what we call the Tucson phase, which is the ranging phase of the market. Tucson is an Arizona city on the border between Mexico and Arizona, and it's the border. It's the borderline. It's the border between two nations. It's the border between the Arizona desert and the Mexican desert. Two very similar things, hot Phoenix phase type things, but it's the border there. The Tucson is the border. It's the 800 period simple moving average that is the moving border where ranges begin and trending ends. So think, and this is a terrible analogy, but this is actually the honest truth about where it came from. Think about people trying to cross the border, Sean, near Tucson. They come across, they can't make it. They come across, they can't make it. They come across. And then when they break through, most of them are going to try to get as far away as they can, right?
Yep.
And when the United States sends people back, they come through, they send them back. They come through, they send them back. Well, it's very similar. The border between these trends is very similar to that same experience. You see movement back and forth around this 800 period simple moving average. Now, there are ranges at other places on the charts. They do exist. But more commonly, we do get ranges that occur near the 800 period simple moving average on a wide variety of financial instruments for a long period of time. Now, tonight we're going to spend time looking at the identification of a range on a longer time frame chart, and then we're going to drop down to a lower time frame chart and trade that range. But before we even do that, there is the Jerome trade. Now, Sean, Jerome does happen to be a city in Arizona, does it not?
Yeah, I guess so. It's an old ghost town or something, isn't it? Where they built the town and then mined underneath of it, and it all came crashing down on them.
Here it is. Jerome, Arizona is in the middle of practically nowhere in Arizona. It's smack dab in the middle of Arizona. You can see it right here on the map in front of us. And as Sean mentioned, it's a mining town. And what did you say again?
I thought I heard the story that they built the town and then mined right underneath of it, and it all came crashing. They didn't think too well about digging holes under their city, I guess.
All right. I also, when Sean and I were talking about the Jerome trade, I also thought of when Elaine on Seinfeld used to call Jerry Jerome. I always thought that was really funny. Absolutely a complete non sequitur. Sean, Bishop Campbell, could I make you the presenter, and could you show us what a Jerome trade is?
Absolutely. All right, let me get rid of this nasty chart. All right, we have simple, normal trend trading system on the chart here. We have the 170 moving average and the 800. Everything that we've talked about up to this point. We've got trends moving, moving down. This is just the latest example. I don't even know if it works, but let's scoot back a little bit. Got the 170 crosses the 800 right here. It says we're in a downtrend. Okay. Trend trade, trend trade, trend trade. Trade it till you get sick. And then in this area right here, this is where something interesting happens, and it's a little bit counterintuitive. At least it was for me in the beginning. But as I tested, this trade popped out to me more than any other trade because it just, and I don't even know why, but it worked probably 70-75% of the time. It's just a great trade. You still have the 170 exponential moving average below the 800, so you're still in a downtrend, but the price crosses above the 800. And it doesn't have to move far. In this instance, it basically just pops above just a little bit, but as soon as it does, you trade the first color change over the 800 while the 170 is still below, and it turns out to be a fairly decent trade. It happens again right here. So you actually get two Jerome trades all at the same time.
Now, what we're saying here is the trend reverses, comes back up to the 800 period simple moving average. We get a hit of the 800, and then we get a reversal back in the direction of the original trend. What I found, Bishop Campbell, is that not only do you get Jerome trades that go in the direction of the trend, which are just gigantic trades sometimes, but you will also get trades in both directions, and we'll show that in a moment. The first method of the Jerome trade, though, is a hit on the 800, and then there is a ceiling created in this example that Sean is showing right now, where the pair can't rise up any further above the 800, changes colors, and comes back down in the trend. Sometimes those trades are gigantic winners, and sometimes they are just mildly big winners. You put a stop loss above the highest high that the candles made, the actual real price made, in the course of rising above the 800 period simple moving average. And Bishop Campbell, there are a variety of different places to put the profit target, but one of my favorite places to put the profit target in this instance is either the 170 period exponential moving average, which is a great floor on the range, as you can see right in front of you right now. So the 170 exponential moving average, you put your mouse right over it, that red moving average flowing around right there, that's a great profit target on the Jerome trade, the standard Jerome trade. In fact, we'll see examples later on in the evening where that's actually not a bad place to buy in the opposite direction on the Jerome and go back and forth until the trend breaks. We go back through the 170 solidly, and then we just take off forever. Sean, I almost called you Jerome just now. The Bishop of
It's okay.
Jerome.
It works.
Jerome,
Bishop
Italy.
Jerome.
Get it? The Bishop of
I love
Jerome.
Oh yeah.
Have you ever been
This is
to
just getting
Jerome,
better.
Italy?
This is just getting better.
It's
I'm
just
gonna
getting
be like
better.
the Pope soon.
You could be the Pope soon. All right. I interrupted you. I want to let you keep going.
That's all right. I think that's the basics of the Jerome. Let's go see if we can find another one. This is a great one. It's 170 still below the 800. Shallow trend.
Yep, we
Price
come back
pops
from the
above
trend. We
800.
rise up to hit the 800.
Yeah, rise up to hit the 800 and first color change, and then you can, like you said, you can pick that 170 as a profit target, and it's a great trade.
Yeah. Now, there are several Jerome trades sitting on this chart right now. If you pause for just a moment, don't move your chart. I'm gonna freeze the screen capture, and I'm gonna circle several trades. Sean, can you see these?
Yeah.
All right, this is for the purposes of the recording. I'm going to guide you through the process of showing us these trades, Sean, one by one, because they are visible now on the recording, but they're not visible in the actual webinar. Sean, on the left-hand side of your screen, you see the stochastic oscillator rise above 80 and turn green at the same time we're hitting the 800 period simple moving average. You could put your cursor over that area right now, and we'll hand this over to you. Perfect. That is Jerome trade number 1, that area. There's actually one maybe even a little bit to the right of that, but either one would be perfectly fine. Remember, not all of them are going to take profit. Some of them are going to stop out. That's a great trade with the trend. A little bit later on, we get another move above the 880 on the stochastic, and we get Jerome trade number 2 if you want to box that in. I boxed that in on the recording, and we got that one right there. We get another one not long after, and these are just color changes at the 800. Excellent. We've got that one right there. And then we get another one or two, although I love having the stochastic there to help us out.
Yeah, it weeds that one out and leaves you with this one.
And then we get a third one not long after. Now, all of these are in the direction of the most recently continued trend. All of them are hitting the 800, and the definition of a range isn't just bouncing back and forth. There's a long history of calling a range trading back and forth. Jerome states the following: range trading isn't just about trading long and short. It's about finding a definable boundary and trading against it. This is a unique aspect of the Arizona rules of trading, and in fact the new ones. And I'm not trying to redefine range trading for the entire world. I'm not that immodest. I probably venture to say I'm kind of immodest, but I'm not trying to be ridiculous here. I'm saying that we might not know where the bottom boundary is. Right, Bishop Campbell? That's one of the main problems with range trading, is range trading supposes you know where the bottom is. I can't find my real bottom half the time. Let alone
Yeah, exactly.
Let alone the bottom in a market.
You're assuming there's two defined boundaries, when you're right. In reality, there can only be one, and the 800 works beautifully as that sometimes.
If you take the possibility that we've been thinking about range trading incorrectly for years, and I guess I am being totally immodest, and you suppose that financial markets are too fickle to create square boundaries, and instead you consider that the 800 is a top or a bottom boundary at the completion of a trend, we forget about the necessity to trade back and forth. We dump that supposition because we don't know yet where the bottom is. And we use that 800 period simple moving average as a boundary up against which we're going to bounce. A wall that is dynamic, yet doesn't move too much, that creates a place for us to take a trade. Natural questions include, where does my stop loss go and where do my profit targets go? One excellent place to put your profit target on every single one of these Jerome trades that is squared up on the chart in front of us is the previous low drawn with this blue support line on the chart. Sean, if you go back just where you were and you leave that blue line right where you had it, it was perfect. That blue line is a magnificent profit target on every single one of these trades. Once again, most people who teach or think about range trading suppose that at that level you would get a bounce and you would trade in the opposite direction. I want to say it again and as many times as necessary. You don't need to trade in the opposite direction. We need a profit target for the original trade, and then we can wait for the market to do anything that it wants to do, whether it's initiate a new trend or come back up and strike the 800 all over again. What I'm trying to say here is what this instantly does for a range trader is remove the quandary associated with am I ranging or trending. Because if you begin to trend, you'll identify it and then you'll start firing off diamondback trades. And that'll be great. Below your second Jerome trade on the chart in front of us right now is a change of color diamondback trade, Sean. And it's right there where you're, to the right where your mouse was just now. Yeah, exactly. Right there. That's a diamondback trade. We don't even worry about divergence here, and we can look at divergence on this, but that's a different webinar. What you've got right here, Bishop Campbell, is the removal of any necessity to worry about the bottom of the range. We've taken profit on our range trade, and if we want to start trending now, well, God bless America. Who the crap cares?
Exactly.
Go to your right on the fourth Jerome trade. Take a look at that one. We take profit at the blue line. We change colors and come back up, and we have no diamondback trade. There ain't no diamondback trade there, so it doesn't matter. There isn't a buy trade either. We're not worried about it right now because the trend is down, so we don't care about it. And because we don't have a change of color for a diamondback trade anyway. And it removes 1/2 of all the range trades, but it also removes a lot of the uncertainty that surrounds range trading, because we thought from the beginning of range trading's birth that you had to trade in both directions, but you don't. In this case, we actually just want to trade in the direction of the trend that we have, which is the 170 is underneath the 800, but we've hit this wall, and we want to use that wall time and time again for quick profits. So the difference between diamondback trading and Jerome trading or Tucson trading here is that we're really looking for the 800 to provide a wall. Boom, 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 boom. And it may result, someone may escape over the border. They may get over the border. That may be, congratulations, welcome to America as far as I'm concerned. But we don't know that that's going to happen yet. And our supposition is that there's going to be a bounce against this wall several times, even in the midst of some significant trends. What are your thoughts, Shawnee P?
Oh, hey, Bishop's okay, but come on, man. No, I think it's great. I think that it's, like you said, I think it's pretty revolutionary that you can think about trading one boundary instead of two. It takes all the pressure off of it, right? I mean,
right.
You can just say, look, I'm waiting until this thing proves itself again at the 800, and then I'm going for it.
Right. Exactly. We're not worried about trading it back up. Now, two questions came through this that are really interesting. One is, how do you use the 170 period exponential moving average as a profit target? Sean, you could simply identify the location of that moving average at the time you take the trade, plug that number into your trading platform, and you're done.
Yep.
That's number one.
Exactly.
And then number two, you could just draw that blue line that you drew, which is across these lows at the that's exactly what I wanted to do. Yeah, draw that line where those lows are to the left. The far left, you see those candles at the bottom left. There you go. That's a fixed point in time. It's not the boundary where we want to buy anything. but it is the profit target. Remember, we never get the whole profit target anyway. Another great question that came from Bob in Houston is, what about the 170 crossing above on the far right Jerome trade, the fifth Jerome trade? This is what we call, Bob, we call this, what I would call this the mining town that we're building houses on top and the bottom falls out of it. There's this one, last move where the previous trend, it still has just like giant amounts of sucking power on this currency. And this is, Sean, without a doubt, in my mind, this is the most powerful version of the Jerome trade. And when we come back in a moment, we're going to look at that in particular. We're going to add some divergence to it, and we're going to build some rules around it. Jerome trade number one, the standard Jerome trade is in the direction of the previous trend, number one. Number two, the financial instrument has struck the 800-period simple moving average. The Heikin-Ashi candles have changed color in the direction of the trend, in this case from blue to red. Stop loss goes above the real price, so the real candle price, and the profit target goes at a previous low. You can reverse those rules at the conclusion of an upward trend, but we'll keep the continuity here. And when we come back, we're going to do Jerome plus trading. Bishop Campbell, before we introduce the Jerome plus trade, did you have some religious music that you wanted to play?
I did, yeah. I need to play that at the beginning of every webinar. You're right. I'm really embracing this new identity that I'm getting here.
As the bishop title?
Yeah, the bishop. I'm starting to wake up every day and...
So blasphemous. Well, here we are. I'm Rob
You know
Booker.
what else it does?
Yeah?
It calms me down before, you know what I'm saying? Like, it just brings me to that place where I have clarity.
Yeah, sure. Sure, I don't think you're crazy. I'm Rob Booker, joined by Bishop Sean Campbell. Arizona Rules Webinar 3, Part 3, the Jerome Plus Trade. Here's what I'd like to ask you folks to do. As you already know, we have the MACD indicator drawn on our Arizona Rules charts. Traditionally, the MACD is set to 12, 26, and 9. For the Jerome Plus trade, you can leave your settings at 12, 26, and 9. Or you can do something interesting, and you can multiply each one of those numbers by 2.5. What that does is it creates a MACD setting of, get this, 30, 65, and 23. I've put those numbers up on my screen so you can see them. 30, 65, and 23. This elongates, smooths out, and slows down the the MACD indicator, which is an indicator of momentum. What it does when you do this to the divergence indicator is it magnificently slows it down to such a great degree that we hardly ever find divergence at all. The basis for the Jerome Plus trade is divergence that occurs, guess when, around the 800 period simple moving average at the conclusion of a previous trend. I'm going to share these rules with you. Bishop Campbell will monitor the questions that come through, and every so often, Bishop, I will pause and give you some time to read out some questions that have come through. What I'd like to do now is share with you the rules of the Jerome Plus trade. This has got to be my favorite trade so far in all of the new Arizona rules. Without question, this is my favorite of all of them. In the previous section of our webinar series, just a moment ago with the Jerome trade, we described the process of using the 800 period simple moving average as a boundary on a range, and then removing the necessity to create any additional boundaries for the range. This is, I think, an innovative approach to trading a range, which is ordinarily viewed as trading back and forth, buys and sells. Instead, for the Arizona Rules style of range trading, otherwise called the Tucson phase, the market has found a trend and we want to keep that trend's bias. It's also found a boundary, which is the 800 period simple moving average. We don't know where the bottom for buying exists, but we do know where we want to enter a trade. We want to enter that trade along the boundary. Imagine for the moment that the 800 period simple moving average is a somewhat elastic racquetball wall, and you are smashing a ball up against that wall. When it comes back towards you, there is no wall behind you, no wall of glass. You're actually on an outdoor racquetball court where the boundary exists up against where the ball can hit. But there's no boundary behind you, so if the ball flies out behind you, it can go for a long way. The 800 period simple moving average is a somewhat elastic boundary. It's the top side of a range or the bottom side of a range, depending on which direction we've gone with the most recent trend. A Jerome trade looks for the price to hit the 800 period simple moving average at the conclusion of a trend, then change color, and then we trade with that original trend for a quick profit at a previous high or low. It's not a very sophisticated manner of trading, but it doesn't mean it doesn't work. Here's a method of narrowing down the number of Jerome trades that you take. It's a little bit more complex. It wins a little bit more often, and it's my favorite trade in all of the new Arizona rules. Once we set our MACD to 3065.23, we can draw our own divergence, or we can let an indicator draw divergence for us. On the chart in front of us right now, we have the MACD indicator that draws divergence automatically. We have the Australian dollar, US dollar, which is the primary currency pair that I enjoy using for this methodology. However, I have watched this on indexes and individual stocks, and it is magnificent. I've got the 5-minute chart open, but you could open a 15-minute Aussie dollar chart, which we're going to do in just a moment, or the 1-hour Aussie dollar chart, which we're going to do in just a moment, and it would work just as fine. In fact, if you find a Jerome Plus trade on a 1-hour chart, you can go down to the 5-minute chart, which we'll do in just a moment, to pick a trade. On this 5-minute chart here, we had a previous downward trend. We know that because the 170 period exponential moving average is below the 800. Then we saw price rise up to hit the 800 period simple moving average. And, well, what did we get? We got a Jerome trade. Boom shakalaka. We got blue turning to red in a very small space, and that trade would stop out. Let's check for just a moment to see if that Jerome trade, if we have the stochastic set to, what do we have it set to? 60-20-20?
That's correct. The most normal average settings you could have it on.
In this instance, we were not only at 60-20-20, but we definitely were also overbought. And there's a Jerome trade that's somewhat of a false signal. By smoothing out the MACD and waiting for the first bearish divergence, second or third bearish divergence that we see on the chart, which is accompanied by strong volume, we get a higher probability Jerome trade. Let's take our pink box here, and instead of looking at the Jerome trade at the 800, let's look at something different. Let's say that once we cross the 800 and create bearish divergence using our ultra longer term smoother settings on the MACD, this is our big moment. It is my favorite trade, and coming soon to the trade app for Android, iPhone, and the Windows Marketplace is the Jerome trade coming through on these charts because it is so good. We hit the 800. We have a bias for downward movement, even though, Shawnee P, we have the 170 crossing above the 800. We've got this bias for a little bit of range right now. And that's the kicker. We think that we're going to get one attempt here to get a big move lower that continues in the direction of that range. And the 800 was the warning sign boundary. The divergence is the indicator that we're going to start to take a trade. And the change of color following that divergence, right in this right-hand area after the divergence occurs, That's the time when we want to take the trade. We see a spike in volume, that's extraordinarily good, and then the thing just takes off. These trades have a natural profit target at a previous low, as we discussed earlier, or at the 800 period simple moving average, which isn't going to move very much and can act as a somewhat stationary profit target. Bishop Campbell, if you were learning this for the first time, what would you ask?
What stops you from going straight into a diamondback as soon as that 170 crosses over?
It's the most naturally awesome question in the entire world, and the answer is this: absolutely nothing. If you want to trade both phases of the market, then trade both phases of the market. Let's take a look at the Australian dollar, US dollar, side by side with the 12, 26, and 9 on this same situation. At least I think it's going to be the same situation. So right here, we have the same situation. Bishop Campbell, we get an Arizona Rules Diamondback Plus trade right here with the new trend, and we take it.
Yep.
And then we get out of that Diamondback Plus divergence trade when we see that this Jerome trade is about to fire off. And we get both. Other questions that have come through?
Beautiful. No, I think that covers it.
All right, here's another
that's the major
example.
question.
This is the Arizona Rules Tucson Phase Jerome Plus trade. It's a range trade that uses the 800 simple moving average as a boundary and divergence as the alert that a trade is coming, and a change of color plus volume as an indicator to enter the trade. In this example, this is the most previous example back from the one we just looked at. We have a downward trend, a move up to the 800, and then divergence created, higher highs on price, lower highs, on the indicator, and then we get a change of color and continuation of the trend that we were in just moments ago. This is a Jerome Plus trade. Let's look at another example. We have a downward trend, 170 below the 800, a rise up to the 800 period simple moving average, and then divergence. Higher highs on price, lower highs on the indicator, and a change of color and a move down. We move down below the 800, so we can't use that as a profit target, but we most certainly can use previous lows as our profit target. And we might not get all the way to the previous low right here, so this might stop out. That's fine. We're not going to win on every trade. Or you might just take profit. You might be smart enough, smarter than me anyway. Here's the most previous example before that. 5-minute chart, 170 below the 800, rise up to hit the 800 period simple moving average in this area. We don't hit it until right here, so this divergence here doesn't count, and then we get divergence across these candles right here. Wouldn't matter anyway. I'd take either one. Doesn't matter. It doesn't stop out. Divergence. Higher highs on price, lower highs on the MACD, a spike in volume that comes later, but we get a change of color, Bishop Campbell, and then a giant move downward. Once again, a previous low is a completely adequate profit target. That's a Jerome trade. Here we go. Here's a Jerome trade in the opposite direction. I'm trying to make it so it's really visible. This one's going to be a little bit difficult because it's a very, very slight Jerome trade. Here we are, hitting the 800 period simple moving average from above and falling down to the 800 with price. We are making lower lows on price, higher lows on the MACD. Absolutely no spike in volume whatsoever, but you can still get a buy trade back up to a previous high. See if we strike the 800 period simple moving average right here, and we do. Shawnee P. Bishop
That's
Campbell.
a great trade.
This is just a great trade. These Jerome trades just send tingles down the right back side of my mouth. Wait a minute, that might not be the Jerome trade. But this is
that's
a Jerome.
your wisdom tooth, man.
I got to get that taken care of. Here we are. Lower lows on price, I want you to be able to see it really nicely, so it's on the far right of my screen. Lower lows on price, higher lows on the MACD, increase in volume as we hit that 800 period simple moving average boundary, and a pop upwards. All we're trying to do is get to a previous higher low. Is this highly accurate, somewhat accurate? Well, it's highly accurate. Here we are, Australian dollar 5-minute chart. Once again, we rise above the 800 now, and the first divergence on the 3065.23 that we find is over here. We already could have started to trade or want to trade the Diamondback trades, but we've got one last chance at the Jerome. We do fall. Do we hit a previous low? We get very, very close to it. We might not do it. That might stop out. You might get your stop loss to break even, and so on and so forth. What I want to do now is switch to, because it's now getting boring because you're just seeing so many of these over and over and over again. I want to switch to the 15-minute chart, if that's okay. And we'll just back up. I'm going to close my eyes and back up to a random spot on the charts. I've got my eyes closed. Okay, here we are. So I'll move forward now. We're in a downward trend, and going to put the template on the chart and move forward. Here we are. Here we are on the Australian dollar, US dollar 15-minute chart. Downward trend, 170 below the 800. We rise up and hit the 800, and in this area over here, it's quite small, but I will expand it in just a moment. We get divergence. It's our first divergence. Oh, it's gone now because I expanded the chart. What a bummer. Oh, that's why it did it. I had that green stupid box checked. Okay. Forget I said any of that. I'm just backing up to that place where I drew that. All right, here we go. We rise up to hit the 800, 15-minute chart. We create our first divergence. Higher highs on price, lower highs, and a nice spike in volume leads to a wonderful Jerome Plus trade. Not only to a previous low, but further than that. Here's an example. We rise up and hit the 800 period simple moving average on the 15-minute chart. Higher highs on price, lower highs on the MACD. Boom shakalaka, another trade. Here we are hitting the 800 period simple moving average. Higher highs on price, lower highs on the MACD. And guess what? It looks bad until you realize that we get very close to these previous lows, and then we take off, and the Jerome trade in that case is over. It's all done. It's over. It might stop out, but that's the best we could do. Here is an upward trend leading to a drop. We hit the 800 period simple moving average and get no divergence. That means no Jerome trade. Because we expanded our MACD settings to 3065.23, we don't get divergence here that we might ordinarily get. We get a bounce back and forth around the 800 here, but we're not taking anything. We're not doing anything. We finally get a Jerome trade because the trend was up. We finally get one on a cross below the 800. We get divergence right here with that trend. Lower lows on price, higher lows on the MACD, a change of color, and a move upward. Why did we not take this trade over here, Bishop Campbell? Why did we not sell there? Because the trend was still up.
Yeah, we were coming down from an uptrend.
Yeah, so we're still going to favor the bullish trend. Now maybe that's counterintuitive for a range trader, but when we speak about range trading with the Arizona rules, we're really talking about boundaries. We're not talking about fixed squares on price, which are really, really difficult to do because the market doesn't really act like that. Then we go into a downtrend, Bishop Campbell, right here in this area.
Yeah.
And then we get a Jerome trade going in the exact opposite direction. Now, that is the definition of why I love Jerome Plus trading. Hit the 800 again, create a divergence. This is the first, what I would call, significantly crappy trade that we've seen so far in the Jerome trade tonight. This is a 15-minute Australian dollar, US dollar chart right here. It's a crappy trade.
You're on a 12.26.9 too, so that may not even be there if you're on the bigger MACD settings.
Yeah, let's go to the 15-minute chart and back it up here. Or switch my settings right here. Thank you for pointing that out.
People are basically screaming it in the questions. So.
Thank you, everyone. Very much appreciate that. My mouth is on fire. That is a Jerome trade with higher highs on price, lower highs on the MACD, a spike in volume, a move down, And once again, even the crappy ones almost get to the previous low. They almost get to the profit target, and then we forget about it until we come over here. We get rid of those. I hate those price candles. I hate them. We get a move down through the 800 period simple moving average, and we get a bullish divergence, and we probably don't get to a previous high here. We get close. We don't get to a previous high there, and that's not a winner chicken dinner. I'm going to move to the 1 hour chart and put the template on. We are focused primarily right now. Oh yeah, now we got all kinds of problems. So I'm going to cut everything off of this chart completely. And see if we can zoom in a bit. I've managed.
I want to trade that one.
I have managed to explode my charts. Look at all these lines down here in the ether nether regions. That's hilarious. There we go. There we go. I got rid of them. So here we are looking at the 1 hour chart. We are below. We have a downward trend. Hit the 800. Create our divergence and fall. Upward trend, fall below the 800, create our first divergence, have a change of color, and that stops out. Upward trend, fall to the 800, create divergence, change colors, jump upward. Magnificent. Rise to the 800, create divergence, fall lower, easily hit a previous low from over here. I'm going to show these examples over and over and over again. Rise to the 800, create divergence. Takes a while to complete, but we do get a fall lower from here. I could show this all night, but it's going to bore the ever-loving crap out of everyone. Let's take a random currency pair once again. The Euro Polish Zloty, 1 hour chart. Let's see if the Jerome trade can work on this. Here we are. This is the Jerome trade on a currency pair that most people in their entire lives will never see. We get a rise to the 800 in a bearish trend, a hit of the 800 most likely. We do hit the 800. We create bearish divergence in this area, and then we fall. We do it again over in this area, and then we fall again. We rise above the 800, and let's see if we can fall and hit the 800 and create bullish divergence, which we do over here, but we don't get divergence. We get bullish divergence right here. This is crazy stuff. Right here we get bullish divergence for the first time after we hit the 800, right here. And there's a nice move upward.
So with the MACD settings, Rob, again, we're on 12, 26, and 9, but you slow them down so that it takes away some of the false signals, right? I mean, if they want, if you wanted to trade it with a 12, 26, 9, you could.
You could probably trade it profitably with a 12, 26, and 9, and it's unnecessary to slow it down. That's exactly right.
Yeah. I mean, it's just preference.
All right, that's the Jerome Plus trade. We've looked at a lot of examples. To summarize it again, number 1, you look for the trend. Number 2, you look for the hit of the 800. Number 3, you look for divergence in the direction of the trend. You take a trade on a change of color with a stop loss below the recent low, above the recent high, and a profit target at the recent high or low. That's the Jerome trade with a plus on it. With a plus on it. Plus, plus, plus. Why don't we play some of that music? You ready to do that again?
I'm ready.
Let's fade out with that music, that beautiful.
If you take the candles off the chart and you start listening to the monks chanting, I mean, I go to a very peaceful place.